Major developments have emerged across silver futures markets, following a trading halt that took place during Wednesday's session, with data now confirming a series of significant movements in both open interest figures and physical vault inventories. The events of that session and the market activity that followed are drawing attention from traders and market observers across multiple sectors of the financial industry. March silver open interest on the Chicago Mercantile Exchange plunged to 10,526 contracts, a decline of 11,356 contracts from the prior session. That represents a reduction of more than 50% in a single trading day. As a result of that decline, potential delivery obligations dropped from over 110 million ounces down to 52.6 million ounces. During Wednesday's metals trading pause, 31,828 contracts changed hands, while retail participants were completely locked out of the exchange. When trading resumed, silver prices had already moved $4 lower. Subsequent waves of selling drove silver down approximately $6 in total, from $91 to $85. That decline is described in the source material as a series of coordinated moves rather than organic selling activity. Following these events, silver prices recovered from the $85 level, which corresponded precisely with the 150 exponential moving average on the hourly chart, a level that had been previously identified as a key technical confluence point. From that low, price subsequently moved higher to $88, where it currently trades. Veteran trader Peter Brandt has since publicly addressed Wednesday's session, stating he is now openly discussing threatened lawsuits against the Chicago Mercantile Exchange. These developments in the paper futures market have unfolded simultaneously with notable physical inventory movements in both Western and Eastern vault systems, regulatory changes out of India, and a significant legal case involving Jane Street and Terraform that is currently before a Manhattan federal court. Each of these storylines is directly connected to the broader picture now emerging in silver markets. Turning first to the physical vault data that emerged in the wake of Wednesday's trading halt, Comex inventory figures reveal that 1.3 million ounces of silver were drained from registered vaults during the period when the exchange was paused. The breakdown of those withdrawals is as follows. 218,000 ounces were adjusted out of Brinks registered inventory, 624,000 ounces were withdrawn from HSBC, 25,000 ounces left JP Morgan, and 619,000 ounces were removed from MTB. Following these movements, total registered silver on the Comex now stands at 86.13 million ounces, with total Comex inventory across all categories at 360.64 million ounces. The coverage ratio resulting from these figures sits at 0.60. This means that registered silver currently covers only 60% of 1 month's worth of open interest obligations. When registered silver is divided by total open interest, the resulting figure is 0.14, meaning that for every 10 contracts outstanding, there is physical metal backing for just 1.4 of them. An additional figure being highlighted is that 54.51 million ounces have left Comex vaults over the past 30 days, representing a 13% inventory decline within a single month. Alongside these Western vault movements, Eastern markets continue to reflect a pronounced premium. Shanghai spot silver is currently trading at $97, with Shanghai futures at $100, while Western spot silver sits at $88. That represents a $9 premium being maintained in Shanghai through the period encompassing the trading halt, the price decline, and the subsequent partial recovery. The source material characterizes this persistent premium not as temporary arbitrage, but as structural separation between Eastern physical demand and Western paper pricing. Regarding the specific mechanics of what occurred during Wednesday's session, the source material draws a historical parallel to events documented in Edwin Lefebvre's work titled Reminiscences of a Stock Operator, which described how market insiders would engineer sharp price declines to clear speculative participants before major institutional positioning. The November 28th session is cited as a directly comparable prior instance of similar exchange activity. Following that November event, silver subsequently advanced 120% over the 60 days that followed. The source material presents this historical sequence as factual context, without asserting that an identical outcome will follow the current episode. The source material also notes that the pattern of a significant low being purged, followed by price moving higher, identified as a swing failure pattern, was observed on the hourly chart when silver declined to $85, bounced from the 150 exponential moving average, cleared the Tuesday 9 o'clock New York session low, and subsequently closed higher. Price then advanced from $85 to the current level of $88. This pattern is described as observable across multiple timeframes and asset classes, including futures, foreign exchange, cryptocurrency, and metals markets. Significant regulatory developments out of India are adding a further dimension to the current precious metals landscape. India's Securities Board has authorized $385 billion in actively managed equity funds to allocate up to 35% of their holdings into precious metal instruments. This represents institutional capital receiving formal regulatory permission to rotate into hard assets at scale, rather than retail participation. A second regulatory measure from India carries additional significance. Starting April 1st, India's regulator has directed mutual funds to use domestic stock exchange spot prices to value physical gold and silver holdings, moving away from London Bullion Market Association benchmark prices. The source material identifies this as a formal decoupling of precious metal valuations from LBMA benchmarks. The practical effect of this directive is the elimination of adjustments previously required for currency conversion, transportation costs, customs duty, taxes, levies, and other factors tied to Western price-setting mechanisms. With $385 billion in managed equity fund capital now directed to value metals using domestic exchange prices rather than London benchmarks, the source material describes this as a structural shift in how price discovery functions across global precious metals markets. Turning to the Jane Street legal proceedings, a lawsuit has revealed a sequence of events involving a former Terraform intern named Bryce Pratt, who was working at Jane Street at the time of the events described in the complaint. Pratt created a private group chat titled Bryce's Secret with a Terraform software engineer and the head of business development at Terraform. According to the complaint, that chat became a channel through which material non-public information about Terraform's liquidity positions was shared between the two firms. On May 7, 2022, at 5:44 in the afternoon Eastern Standard Time, Terraform quietly withdrew $150 million from Curve's 3 pool without any public announcement. Within 10 minutes of that withdrawal, a Jane Street wallet removed $85 million from the same pool, the largest single transaction in that pool's history. The combined drain of $235 million occurred before anyone outside those two firms had knowledge of the change. The peg broke that same night, and 6 days later, $40 billion had been lost across the broader market. On May 9th, while retail portfolios were losing value, Pratt messaged Do Kwon offering to purchase Luna or Bitcoin at steeply discounted prices. This case represents the second lawsuit filed by Terraform's administrator. A prior lawsuit filed in December targeted Jump trading for $4 billion, alleging that Jump inflated the value of UST through a backdoor arrangement prior to the collapse. The Jane Street complaint alleges that insider information moved between the two firms. Do Kwon received a 15-year sentence. Terraform paid $4.47 billion in SEC penalties. The institutions involved posted record profits during the same period in which retail participants absorbed the full $40 billion loss. A Manhattan federal judge is currently presiding over proceedings to determine whether market-making activity crossed into market manipulation in the cryptocurrency context. The source material draws a direct connection between the dynamics described in the Jane Street case: concentrated institutional positioning, information asymmetry, coordinated action during stress events, and retail participants absorbing losses, and the current structure being observed in silver markets, where Jane Street holds a $1.3 billion position in SLV, while retail participants were locked out of trading during Wednesday's halt. The source material presents this parallel as a matter of market structure, rather than as an assertion specific to either asset class alone. Bringing together the full scope of developments covered in this report, the picture that emerges spans futures market mechanics, physical vault inventory movements, Eastern market premiums, regulatory shifts in India, and active legal proceedings involving major institutional trading firms. Each of these data points is drawn directly from verifiable on-record sources as presented in the original material. Beginning with the futures market, March silver open interest on the Chicago Mercantile Exchange declined by 11,356 contracts in a single session, landing at 10,526 contracts, a reduction of more than 50% in one trading day. Potential delivery obligations fell from over 110 million ounces to 52.6 million ounces as a result. During Wednesday's trading halt, 31,828 contracts changed hands, while retail participants were completely excluded from the exchange. Silver prices subsequently declined approximately $6, moving from $91 down to $85 before recovering to the current level of $88. Veteran trader Peter Brandt has publicly stated he is now discussing threatened lawsuits against the Chicago Mercantile Exchange in connection with Wednesday's session. On the physical inventory side, 1.3 million ounces were drained from Comex vaults during the trading halt, with withdrawals recorded from Brinks, HSBC, JP Morgan, and MTB. Total registered silver now stands at 86.13 million ounces, with total Comex inventory at 360.64 million ounces. The coverage ratio sits at 0.60, meaning registered silver covers only 60% of 1 month's delivery obligations. The registered to open interest ratio stands at 0.14, translating to physical backing of 1.4 contracts for every 10 outstanding. 54.51 million ounces have left Comex vaults over the past 30 days, representing a 13% inventory decline within a single month. In Eastern markets, Shanghai spot silver remains at $97, with futures at $100, maintaining a $9 premium over Western spot silver at $88. That premium has persisted through the trading halt, the coordinated price decline, and the subsequent recovery period. The source material identifies this as structural separation between Eastern physical demand and Western paper pricing, rather than temporary arbitrage. On the regulatory front in India, $385 billion in actively managed equity fund capital has received authorization for precious metals allocation of up to 35%. Starting April 1st, Indian mutual funds have been directed to value physical gold and silver holdings using domestic stock exchange spot prices rather than London Bullion Market Association benchmarks, formally decoupling Indian precious metals valuation from Western price-setting mechanisms. Regarding the Jane Street legal proceedings, the complaint details a sequence of events from May 7th and 9th of 2022, involving the flow of material non-public information between a former Terraform intern working at Jane Street and Terraform personnel, a combined withdrawal of $235 million from Curve's 3 pool within a 10-minute window, and subsequent offers to purchase distressed assets at steeply discounted prices while retail portfolios were losing value. Do Kwon received a 15-year sentence. Terraform paid $4.47 billion in SEC penalties. A Manhattan federal judge is currently presiding over proceedings related to whether market-making activity constituted market manipulation. The source material identifies the structural dynamics described in that case: concentrated positioning, information asymmetry, coordinated action during stress events, and retail absorption of losses, as relevant context for understanding current conditions in silver markets, where Jane Street holds a $1.3 billion SLV position. The source material also presents the following as countervailing risk factors. The Chicago Mercantile Exchange may continue rolling March contracts into May and July to defer delivery pressure. The Shanghai premium could narrow if Chinese industrial demand softens seasonally, and a comparable exchange intervention could be repeated at the next delivery period. These are presented as documented possibilities rather than projections. All figures and events referenced throughout this report are drawn directly from the source material and are recommended for independent verification through primary data sources, including Comex vault reports, Shanghai exchange data, court filings, and regulatory announcements. That concludes this broadcast report on current developments across silver futures markets, physical inventory flows, and related institutional and regulatory activity.